It's the day of days, rate days. I don't know who gets excited about these days, but Paul, I'm sure you wake up in the morning, you spring out of the bed and start shadow boxing, knowing there's a big day ahead of you. Another 25 basis points today. When's it going to end?
Mate, I absolutely concur. My radio is set to the Rocky theme music for the first Tuesday of every month. That's how I wake up, and then bam, straight out the door and running upstairs, shadow boxing. Not the case. Not the
We
case.
shouldn't laugh about it because
No, I was going to say I'm not that much of a sadist, mate.
as expected, we've been telegraphing it, much like economists, of which we are not. We're just a couple of interested parties that work in and around mortgages, trying to help investors and mortgage holders make more informed decisions with their mortgages. There's a lot of Aussies doing it tough now, and here we are, another rate rise. It's been happening since May of last year. It's a fastest spike in rates in as long as I know, and probably in recorded history in Australia. Paul, no real surprises today with the RBA announcement?
Unfortunately not, mate. And I think, I guess that's probably the only real upside to this is that people aren't going to be shocked or surprised. I think realistically, this is the time where, most people, if they haven't already been prepared, then they really are now starting to think about, okay, I really need to get prepared as to A, if my loan's going from fixed to variable, what's going to happen? Or B, if it has already happened, how can I afford my loans or loan, and what can I do about it if it's not really where I want it to be, and is there anything I can do about it?
A lot of moving parts in this market, and it's really unique. One of them is the fact, and you make reference there, that a lot of people in time will come off fixed rate mortgages, which may start with a 1, most likely start with a 2, into variable rate mortgages. So they're going to be hit with 4% increase straight off the bat, and they'll need to do something about that. That's interesting. The fact of just the incremental cost of mortgage repayments since May of 2022 is starting to impact people's back pockets. That's something to be considerate about. And a big thing for me, Paul, is this notion around what they call it mortgage prison. That is, even if you want to refinance your loan to go from when it goes from a fixed rate product to a variable rate product, you may not be able to refinance the loan back into interest only because of your serviceability. So there's a lot of moving parts with this.
Mate, you're exactly right. And, we've heard the term interest rate cliff being bandied around and essentially coined that phrase as of about 6 months ago. And that's done the rounds pretty heavily. And I think, to your point, this mortgage prison is going to be the new term that's going to be used for the better part of this year, I believe. And for those who are listening and maybe not understanding what this actually means or what the term references, ultimately it means that, when you got your loan, you were serviced with about a 3% buffer. Anyone who took out their loan after October 2021 or in October 2021, APRA raised their buffer from 2.5% on top of what you were paying to 3%. So basically stress testing you to be able to make your repayment with 3% additional interest on top of that. Obviously, we've exceeded that 3% now. So APRA's probably got some credence as to why they did that. But what that's doing now is basically meaning that if you haven't had significant enough pay rises or increase in your income in the last year and a half, 2 years, then if you've got a rate that you're not happy with, then no other banks technically are able to actually service your loan. So you actually are locked into that rate, even if it's variable, unfortunately, because there's two components. One is the serviceability, but the other one is also your equity that you have in the property. And obviously with a lot of property markets declining in value over the last 12 months, a lot of people are in less equity positions than what they previously had. So their LVRs or loan to value ratios are also now dropping below where a lot of banks would be comfortable taking on that debt as well. So there's a few factors working against some borrowers.
Yeah. Interesting you say that, Paul, because there was a lot of commentary coming out over the last sort of month or so where they thought the APRA, the prudential regulator, would scale back on that 3% buffer. And they've pretty much come out over the last couple of weeks saying, no, the 3% remains. So on that basis, if you've got a bank variable rate at 7%, they're putting another 3% on top of it. So you're getting, your serviceability is assessed by a lender that you're paying interest at 10%. And that is a prison, because you can't, for a lot of people, their serviceability won't allow them to move from the bank that they're in, because a new lender that you take that loan to will say, no, you can't service it. So you're stuck with that lender. Now, if lenders behave appropriately, which they sometimes do and they sometimes don't do, they should be able to keep your rate competitive, and they're going to want to try and keep you as a customer, right? So you may be able to get some flexibility there. Back in the good old days, you used to be able to go, no, I don't want a fixed I just want to be variable, just change it. But now it's a whole new application. So you won't be able to even do it with your current lender because they're going to be assessing you on 10%. So as long as you pay your mortgage, you're probably going to be okay. I don't really hear banks calling up very often going, no, our serviceability metric says you can't afford that loan anymore. We're taking it back and you need to sell your house. If you're paying your mortgage, you're probably okay. What's going to happen though is that it's going to really decrease the competitiveness of being able to secure better financing. Hence the reason why of this last period of time, Paul, refinancing has been off the charts. This is people getting ready for this environment of rising rates. Refinancing when they can, when serviceability is probably a little bit better. Now, how do you change your serviceability? You got to earn more money. So you got to ask your boss for a pay rise or try and generate more money out of your rental income right now, or you change your cost base. So you got to really tighten the belt and change how you present yourself as a customer to a lender. That may change your serviceability, but Paul, it's tough times ahead.
But you hit the nail on the head with a couple of things there. And I think a lot of people sort of get to this point of hearing the term mortgage prison, or potentially also hearing, no, you can't do anything from either their bank or their mortgage provider, be it their broker. And I think that's the big part here, is that no is one part of the equation, but there's always, you could do this. And to be completely honest with you, the vast majority of people can have something happen. Now, that might mean that they can either switch to a different lender with a different rate. That rate actually might not be better, but they might be able to give them better terms, etc. But the other big things here is that this gives everyone, and this really is the intention of obviously rates going up, is the inflation is caused by spending being above where the government is happy with it to be. So that last point you made, mate, is that this is the time for everyone to there's probably two big things here. A, this is a moment in time. This isn't permanent. And I think people need to remember that what we're seeing right now, as far as A, inflation being at the point that it is, and B, the actual interest rates going up 10 times in 10 successive RBA meetings, is that this isn't going to be consistent. Things that they can do is tighten their belts and look at how they're spending, look at their credit card limits, look at the whole variability of your overall profit and loss as a family or as a household. And the other big thing you mentioned there, if you're an existing property investor, one thing that has happened pretty much across the country, and we've bandied on about this a fair bit, is that rents are still at their highest rate of increases in the last 30 years as a percentage. So the good news for existing property investors is that if you haven't already done so, you should be talking to your property managers, because like it or not, if you're a tenant, rents are going up and that will continue to happen. So that should help your serviceability over the medium and long term as well.
Yeah, and strategically, other ways to change your serviceability base, and a lot of investors will be hearing this now, even owner occupiers. It'll be like, well, maybe you need to recycle some debt. Recycling debt may mean you need to shuffle the decks on the assets that you hold. If you want to capitalize on this market, and this is about mortgage debt, it's not around property, but a lot of people are looking at buying in this market. However, if your serviceability is at a threshold, you may need to be able to X out of some assets and move into other assets. Again, your mortgage broker and your buyer's agent can help you with those type of decisions. But what you need to remember, Paul, and this is a key one, and this is something I've been looking at, observing for a little while, the inflationary pressures which are impacting Australia and the rest of the sort of Western world, operating differently than what they have done in previous times. Now, you need to remember, a third of Australians have a mortgage, a third of Australians rent, a third of Australians don't rent, and they don't have a mortgage. So you still got a third of all Australians, and we're talking about cashed up baby boomers right now. Things are a little bit more expensive for them, but they've got their houses paid off. They've got investment income. They're still out there spending, and that also has an inflationary impact as well. So really, really tough environment for the RBA to make the decisions it needs to make to try and get the economy back to a level of inflationary growth that they're happy with without stifling the sort of the health of the Australian economy. Very, very difficult decisions, Paul. But for your average owner occupier with a mortgage, or even those people who are tuning in this that have quite a lot of mortgage debt against finance, is it too late to refinance?
No, certainly not, mate. I think if anything, it's probably absolute optimal time to refinance. Now, obviously, it's not going to be the joy and hysteria of what we're doing in the refinancing space 2-3 years ago when you took your rate from a 4% down to a 2%, and all of a sudden you found an extra 10 or 20 grand. You're basically stuck with the fact that variable rates are going to be sitting around that high 5s to early 6% mark, maybe a little bit lower for a principal place of residence, maybe a little bit higher for an investment. But if you're not refinancing, some banks are taking advantage of this, this inverted commas or air quotes mortgage prison, and thinking, well, if they can't move anywhere, then I don't have to be as competitive on the rates of that particular person. So there is a huge disparity right now between new business and existing business if you're a client of a particular bank. Now, if you can't go anywhere, that conversation with your bank is extremely, extremely important, because there is huge disparity between the interest rates that are being offered. But in saying that, there are also certain banks out there which have big space in their loan books to actually bring in new customers. Now, if you're that person who has significant equity, serviceability, and rents that are going to be increasing over time, and you're looking to take your debt to another provider to potentially release equity, to get a sharper rate, a combination of those two, prepare for the next investment in this time of opportunity, there is huge, huge markets of opportunity out there for anyone who's looking to take that debt and get active. And it's probably the best and most competitive market for those who are ready and actually physically able to do so.
Good point. And here's a hot tip. When we get to terminal rates, so the top of this market, you watch the lenders come out of the blocks to try and generate new business. That will happen. I think you're going to get a period of mortgage innovation moving forward. You're going to get a period of mortgage competitiveness. And don't be blinkered thinking that you need to be putting or setting your mortgage with one of the major banks. There is a whole bunch of, they call them sort of second-tier banks. And by that, I refer to companies like Suncorp and AMP and potentially Macquarie. And then you also have non-bank lenders and mutual lenders as well. So there's a huge amount of choice. But really only your mortgage broker can find that choice for you and find the best product for you at any point in time. Paul, your team is happy to have a chat with anyone who's sitting there scratching their head going, what do I do?
That's what we're spending the bulk of our time doing right now is clients who are probably thinking, what do I do? I've been told no. I've been told I'm sort of sailing pretty close to the wind with my existing debts, so there's not really many options out there. When you've got a panel of 40, 50, 60 different options, whether it's your owner-occupied debt, investment residential debt, commercial debt, self-managed super fund debt, when we've got the broad blanket opportunities of all of those different markets to get the best outcomes there, then there certainly is going to be solutions that we can find. Absolutely. So finny.com.au, people can jump on the website, click on the Inquire Now button, and they can book in a time to talk with some of our experts immediately, because that's really what we're here to spend our time doing for at least the next 3 to 6 months.
Yeah, hot tip from me, the sooner you get into it, the better off you'll be. Paul Glossop, CEO of Finny Mortgages, thanks for your time today.
Cheers, Phil.
Nice one. Check out smartpropertyinvestment.com.au. Remember, we're there all the time, every day, looking at this sort of stuff, where your eyes and ears to make sure you can make more informed decisions. Smartpropertyinvestment.com.au. We'll see you again next time. Until then, bye-bye.